How's it going, guys? Hope you guys are doing cool. And today I've got another one. Today I'm going to be taking you guys through PDRAs. So I bet some of you guys have heard what PDRAs are. Maybe you've heard it from ICT himself. Maybe you've heard it from ICT students. Maybe you've seen it from X, maybe our Instagram. So today I just thought, you know what, let me just do a basic um short video of what PDRAs are and examples of PDRAs so that you guys can understand what they are, right? And if you already know what PDRAs are, maybe you might just sit there and maybe reflect on this because I bet, yes, you do know, but maybe that you forgot, Yeah, bro. Yes, yeah. It depends on you, though. It depends on you. But yeah, let's get through this, bro. So, without further ado, guys, let's get straight into this topic. So, what are PDRAs? So, here's a little bit of example that I made out, okay, a definition and some examples of what PDRAs are. And then I'm going to be taking you guys through chart examples, like real chart examples of some of the examples of the PDRAs over there. So, definition of PDRAs, what are these? So, PDRAs are premium discount arrays. They are areas on the chart where price is likely to react. So, just think about it as premium and discount. Yeah, right there. Right there. Let me use this so that you guys can see what I'm doing here. Uh, right there, demonstration. Let's go. So, these are zones where institutions leave liquidity or imbalances, so price often returns to these places or zones to continue a move or reverse, right? So they are institutional switchovers, right? Something like that, like institutional rejection zones or continuation zones. Think about it like that, as simple as that. And yeah, let's get through the examples of these PDRAs. So examples of PDRAs are fair value gaps, order blocks, breaker blocks, rejection blocks, and liquidity pools. So in this video, I'm going to be taking you guys through only three of them. Maybe I'll make another video explaining more of them, but today I'm just going to be taking only these three. And that is the fair value gap, breaker blocks, and rejection blocks. Okay. Now, this is a little bit of a diagram that I made that for you to show you guys a premium and a discount zone. How does it look like? So I use the Fibonacci retracement to mark this out if you're wondering. So this is the 0%, this is the 100%, this is the middle point, 50% mean trash, right? So above 50% is the premium and below 50% is the discount. So it depends on the trend that you are looking at. Maybe this was a bearish trend, so you want to mark it from 0 to 100. Premium is where you want to sell, all right? When price retraces into the premium, you want to see shorts, you want to sell price, all right? Something like that. And if we are on a bullish though, you want to see price, right? Price is moving up like this. So you want to see price retrace back to the discount. Respect an example of either of these examples of PDRAs that I mentioned here. And then you want to see price expand further up. Okay. Yeah, that is examples, or this is a diagram to explain to you how premium and discount are marked. And the 50%, the mean threshold is where this is where it marks out the premium and the discount basically on a chart or a range. Okay, so let's get straight into these examples of PDRAs that I marked up for you guys. All right, so there we go. So where to go? PDRAs. Let's go. So let's look at fair value gaps. Let's look at fair value gaps first. So um, what is a fair value gap? Pretty much sure some of you guys have heard what fair value gaps are. Most of you guys use this as your strategy. So this is exactly how to identify a fair value gap. Fair value gaps are three candlestick patterns. You want to look for three bullish or bearish candles in a row, with the middle candle being larger than the other one. All right. So I'll say it depends with the market trend. For example, this is a bullish fair value gap. This is an uptrend market. So you want to spot a bullish fair value gap. So you want to see three consecutive or rows of three candles forming. You want to see the middle points of the three patterns being larger than the two of them, and then you want to see a gap spot. You want to spot a gap between these two. So you mark that as a fair value gap, okay? For a bearish, is the same thing. A gap between two uh high and low candle, that's a fair value gap. As simple as that. And then this is an example of it in a chat. All right, so we got one, to 3, you want to mark out the middle part of the high and the low. That is a fair value gap. So you want to mark that. And yeah, as you can tell here, price respected this at the first place here. You want to see price respect this, it dropped. And then the second time it came and respected the, I'd say the consequent encroachment, if you know what that is. So it's just like the middle part of the fair value gap. And then it starts dropping. That is how price respects a fair value gap. Let's see another example right here. So how to identify high probability fair value gap. Okay, so you just don't want to get into any gap that you just see and then get into start trading it. No, there are criteria that you need to see first before getting into trading the fair value gap itself. Okay, so the first thing that you want to see before entering a trade, when you see a fair value gap, you want to see a liquidity sweep. You want to see price take out liquidity above highs or below lows. You want to see strong displacement or an aggressive move that creates a clear imbalance or a fair value gap. You also want to see a return to the gap, that is a retracement. Yeah, price retraces into the fair value gap before continuing. This is an example of what I just wrote here. The first one, you want to see a liquidity sweep first. So based on this, we don't have a liquidity sweep. My bad. I should have looked for an example with a liquidity sweep, but I'm very sure I got one. But yeah, let me take you through this first of all. So right here, we didn't have a sweep, but we did have a strong displacement though. So you see this series of down close? This is where price shifts, strong displacement. This is the displacement, sorry. And then what happens? You want to see, yeah, an aggressive move that creates an imbalance. So these candles here is an aggressive move. There's huge momentum for sellers. Sellers are getting into the market. And then we got a gap. We got an imbalance right above here and here. So this is in a higher time frame. If you're wondering why this doesn't look like a 3 candle formation and the middle part being whatever, like this one, it doesn't look like this one, right? But this is a higher time frame. If you go to, I think I used the 15-minute time frame. If you go to the hourly time frame, you'll see a good one. But this is a hourly time frame fair value gap. I should have mentioned that. But yeah, that's exactly what you want to see. Strong displacement, creating a fair value gap. And then the next thing you want to see is a return to the gap. This is exactly what just price did. We displace all the way down, see price retraces back, it fills the fair value gap, and then this is where you want to get into the trade. This is where you sell. This is where you stack in more positions as much as you can with proper risk management. And then you want to target the sell side liquidity, which is the data lows or the swing low, which is right here. I mentioned minor sell side, which is our target. That's exactly how you need to trade this one. All right, let me show you another example of that. Right here, we got a bullish example of a fair value gap being traded. So right here, what do we see? We see price expand up with huge momentum candles forming here. What do we see here? We see a shift, right? And through the shift, we see a expansion or a displacement above, right? So what we have here, we got this candle, we got this candle, and then we got this candle number 3. So now candle number 1, candle number 2, and candle number 3. So you want to see the candle, the middle candle being larger than the 3 of them, which is right there. You want to mark out a gap between the 3 of them right here, fair value gap. That is where you want to enter, right? So you want to see price straight above there. You want to see price retraced. Remember, you want to see strong displacement right here. You want to see a return to the gap. So price trades above here, creates a swing high. We traded back into the gap. While respecting the gap, we saw price take out liquidity first, and then after that, just take that as a confirmation, and then enter from here. Place your stop loss right below the fair value gap, and then you want to target the swing high. All right, that is an example of a bullish fair value gap, or a bullish, yeah, something like that, bullish fair value gap. Yeah, this is another example of them. So remember, you want to see a shift, market structure shift, and then through the shift, you want to see, look back before the shift, and you want to spot a fair value gap. So right here, we have this candle number 1, we have candle number 2, candle number 3. You want to see the middle one being stronger or being larger than the 2 candles, right? Creating a fair value gap, right there. I marked that out. You want to see price then retrace back or come back into the fair value gap. Right there, we see price trade into this. We see price respect the fair value gap, and then it respects it twice again before it expands. So you want to take your long entries here, place your stop loss below the fair value gap, and target the swing high, which is the buy side liquidity right there. Okay, as simple as that. Do we have a bearish one? Yes, we do. So this is an example of a bearish one. you want to see a displacement candle towards the left, right there, huge candle over here. You want to see a market structure shift, which I bet this one. These are market structure shift right here. I didn't mark it. Through the formation of the displacement, you want to see the middle part being stronger and creating an imbalance or a fair value gap stroke, which is why here I just mentioned that. Then you want to see price clear the swing low. After that, you want to see price retrace back into the gap. Right here, we retraced fast entry. Price came down. It never really had huge momentum to take out the sell side. So price decided to retrace back. It did, but we never, all right, we never take out the sell side again. So price came back for the third time, and then the third time was stronger, right? So we saw price trade down. This right here, you can tell that price shifted structure again here. So this is like a mini shift that I just wrote here. So this can be your number 2 confirmation for sales. So price displaced with this candle and then retrace back towards this. So I'm going to be mentioning what this is. This is called a breaker block, but don't worry, I'm going to explain what that is. So price retrace back and then we got the sell towards the sell side liquidity. As simple as that. That is how to trade a fair value gap. You can screenshot this if you still don't understand what I just said, because I might be going so fast. So just screenshot it and then you're gonna look it up later on. So let's see if I got another example here. Yeah, this one is like a breaker, so don't worry, I'll come back to that. So as simple as that, guys. That is just an example of a fair value gap, and it's just as simple as that. All right. So let me take you guys through breaker blocks. All right. So let's see what breaker blocks are. Let's see what breaker blocks is. Okay, there we go. So what is a breaker block? Breaker blocks, or BP, all right, is an invalidated order block and signals a market structure shift from bullish to bearish or vice versa. All right, so it's basically an invalidated or a not respected order block. All right, think of it, an order block that failed. That is what a breaker block is. This is an example of it, right? You want to see price trade above. This is an order block. Price doesn't respect the order block, it just respects the tip of the order block. You see there were a series of up close candles before the displacement. You see price trade into that and then expand. That is what a breaker block is. This is a diagram of it. Let me show you an example on a real chart right here. So yeah, this is a bullish example of a bearish order, bearish breaker block, and high probability, how to identify a high probability breaker block, because you can't just enter any breaker block that you just see on the market. There are some that are invalid. All right, so this is how to spot a high probability one. So high probability breaker blocks, you want to see liquidity sweep first. So make sure you want to see these 3 things before you get into or call a breaker block a valid breaker block or trade the breaker block. All right, so you want to see a liquidity sweep first. So this is just what happened. Liquidity sweep first. Right here, I marked it X. The next thing you want to see is, okay, so let me read this for you guys. So price takes liquidity above highs or below lows. This is a low. So price takes out liquidity below the lows. And then after that, you want to see a market structure shift, right? You want to see price breaking structure showing a change in direction. So you see a liquidity sweep, you see a displacement. This is a certain high right here, market shift. So you want to see price displaces, breaks above a high. And then the third one, you want to see a retest of the breaker. You see price return to the broken order block before continuing. So think of it as a retracement right here. Price retraces back into the shift. So this box over here is a breaker block, plus there was a fair value gap that was inside of it. So I combined both of them. So just to increase my chances of getting into this. And that is what price does. It respects the breaker block and then it expands. So for your target though, you want to target the buy side liquidity or the swing high, which is where liquidity is being held right now. So you want to trade back into that, and then you want to place your stop loss just below the breaker block and fair value gap. As simple as that. So this is a bullish example. Okay, let's see what a bearish example. So a bearish example, you want to see a liquidity sweep above highs. All right, that is what happened here. This is a liquidity sweep. And then the next thing, you want to see a market structure shift to the downside. So you want to see price trade down. You want to see a displacement. Price breaks the structure. So it shifts structure or changes character. And then the next thing, you see price trade back into the breaker or fair value gap. That is the retracement. So right here, I bet you can already tell that breaker block works together with fair value gap, because you see here, this is the breaker block. All right, think of it as a series of down close candles before this bullish move right here to take our liquidity that was here. So from this high to this low is the breaker block. You want to mark that. Just see how I marked that with the rectangle right there. That is a breaker block. And then on the process of dumping, we created a displacement with, remember, one, candle number two, bigger, candle number three, and then we created a gap right there. So that is the reason why I say these are breaker combined with a fair value gap. Okay. So price traded back into this point. This is where we get into the trade. We see price respecting this, right? So just assume when price was doing this, you are waiting for more confirmation. So let's say you missed this bearish push right here. So you wait for a retrace back because this created an imbalance. Price comes back, and then these are you can maybe get into a valid trade and then place your stop loss just above here. Or we don't know, maybe you place your limits here. So it depends on how you get into the trade. And then for your target, you want to target the sell side liquidity, which is the swing low down here, like that. As simple as that. That is a very simple concept, right? Yeah, that's an example of a bearish breaker block. So do I have another one? Let's see. Yeah. So look at this. Okay, look at this. This is a very good example of how to trade from daily, oh, sorry, not daily bias. I want to say top-down analysis. So based on this one, you can tell that I have a 4-hour fair value gap right here. Okay, we have 4-hour fair value gap. And then when price respected the 4-hour fair value gap, this was a retracement, by the way. So price was retracing back into the 4-hour fair value gap. And then after this, I switched into the 15-minute time frame to spot an entry point. Okay, so when I got back to the 15-minute time frame, this is what I saw. I saw price respect the 4-hour fair value gap. We traded down, and then on the process of dumping, what happened here? We shifted the structure. This is a market structure shift. And on the process of doing that, what happened? We created a fair value gap here. We already mitigated the fair value gap. So this is candle number one, candle number two, stronger. Candle number three, we created a gap. We already filled the gap, we dumped, but this wasn't a valid dump. You can tell that it's not that strong. Look at the candles. Based on this, we talked about the breaker block. Right here, it's a failed order block. So this is a series of up close candles before the push to respect the fair value gap before the displacement down. So you want to mark out from this high to this low. This is a breaker block. Okay. What happened here? Price retraced back into the breaker block. Right here, retracement, and then a valid point to sell the trade. So this is where you get into the trade. You want to target the sell side liquidity, and that is exactly what happened here. Okay, so think of it, a breaker block really works well with fair value gaps, and you want to do top-down analysis on this one. So it's for entry criteria are almost the same. It's almost the same thing. When you look at this and then look at the fair value gap one, how to identify a valid fair value gap, it's the same. It's the same thing. You see a liquidity sweep first, you see a market structure shift, and then you see a retest towards the fair value gap or the breaker. All right, it's very simple, very simple. And yeah, that is the end of the breaker blocks. All right, so the last one is I want to take you guys through a rejection. So what are rejection blocks? Let's see what rejection blocks are. There we go. Rejection blocks. So think of rejection blocks as support. Actually, it's just as simple as that. So what is a rejection block? It's a brief definition. Rejection block is a price level where the market strongly rejects an area, leaving wicks that show buyers or sellers stepped in aggressively. All right. So by the name suggestion, rejection. All right. You want to see price reject from there. You want to see signs of support. You want to see signs of long, huge wicks rejecting from that key level point. So it can be a very important zone, maybe a demand zone or a supply zone or a resistance or a support zone. You want to see a series of wicks, all right, price tapping into that zone and rejecting back, bouncing back from that point. That is what a rejection block is. It's a price level where market strongly rejects in an important area, what, leaving wicks that show buyers or sellers stepped in aggressively. Okay, huge momentum got into the market during that time. Institution got in. Okay, from a key level point, basically. So let's see some examples of real charts of a rejection. Sorry. Oh shit, of rejection blocks. Man, I think I'm getting flu, bro. I don't like having flu. That should be going crazy on me. What? Answer, bro. Oh, sorry. Sorry for that. This is an example of how to trade a rejection block, and I think these are bearish example based on the sales that you can see right there. All right. So this is a structure of how to spot a rejection block. You want to see price pushing up, right? Higher, no, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Okay, we shift structure, right? We shift structure right here, and then price trade back, liquidity taken. What is here? We got a rejection block right here. So before you spot a rejection block, this is an important zone. Remember this. This is an important zone. This is a supply or resistance zone because we're trying to sell, because price just shifted structure here. So when price comes back to this point, this, you want to see long wicks rejecting from this level. That is a rejection block. Price is rejecting from that key level point, right? So the first thing you want to spot is a supply or a resistance zone. And then price rejects the first time, we shift structure, price rejects back to that point. You want to take some sales because that is a rejection block. But before you take the sales, look at this. You want to see this first. You want to see a displacement candle that equal that will tell you this that will basically tell you it's a confirmation for you to take the sales. So you want to see a strong displacement for a real shift, because this might be just consolidation. A real shift displacement candle right here. You want to spot something like a fair value gap or a breaker block, right? These are breaker block, and then we might get a fair value gap here, combination breaker block plus fair value gap from a shift. When you see a retracement back, and then these are you want to get in for sales, and then you want to target the sales side liquidity, which acts as a magnet for price because it's pulling in, it's holding liquidity or pools of liquidity. You want to see price trading to that point. Okay, as simple as that. So this is a rejection, bearish example of a rejection block. Bullish rejection block, you want to see the same thing, just vice versa. See price trade down, right? Creating lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. You want to see price tap into an important level, can either be a demand or a support zone. You see price a little bit of a range or a consolidation before you see a shift in the market structure, something like this. Price consolidates from this level point, which is now acting as our rejection block. When I see price break out of this high, now we have shifted the structure from creating lower lows and lower highs into creating a new into creating a new higher high. All right. So after that, you want to see price retrace back into this a shift. So that means this is a displacement. So that means this is a breaker, all right, somewhere here. And then we get a fair value gap inside of this. And then this is where you're going to get into the trade. Place your stop loss just below the rejection block. You want to target the buy side liquidity, which is holding, which is a magnet for liquidity pools. All right, so you want to be that. That's going to be your target, and that is how you trade a rejection block. See, these things are almost the same thing. This is an example of a real chart. So what do we have here? Okay, hold on. I don't want to get there first. So look at this. This is an example of a rejection block. Price has been dumping, right? What happens here? When price broke this, we created a lower high, lower low. We came back towards this, but based on this, we can already tell this is a supply zone. All right, I could have marked this. My bad. I should have marked this a supply zone. So this candle here is an order block, but it's a 4-hour time frame or a higher time frame. I think I was using. So think of it this as a supply zone. Combined price is rejecting from this. Once again, that means it's rejecting. That means it's a rejection block. Okay, this is a rejection block. Then you get your sales. So before you get your sales, you want to go to the lower time frame and look for a confirmation for you to take a valid sales. All right, for you to get a sniper one, and then you want to target the sell side liquidity, which is over here. Okay, there's an example of another one. See, price is coming down. We've been going up. We came down, created a lower high, no, higher low, sorry. We came back, but we never broke we never broke above these highs. Price rejects this point. Price came down. We never took out the sell side. We came back again. Okay, so basically you already tell that this is a resistance zone. Now price has been rejecting with huge wicks. Look at the wicks. Price is rejecting with huge wicks. That means these are rejection block. So when price came to the third time, what happened? We dump all the way down to take out the sell side liquidity. And I think price came back again for the fourth time and respected this one again, dumping price. All right. So that is how rejection blocks are formed. That is how rejection blocks you need to trade rejection blocks just as well as how price is rejecting at this level. All right. Let's see an example of how to trade a rejection block. Okay, so based on this, so you see this, this is one, this is this. Okay, so this rejection block right here, price has been pushing up, price is trying to reverse, so we're trying to take a sell. All right, so these are bearish example. So when price came back here, we created a huge wick, and price has been resisting from that zone. Look at this, we resisted, price came back again, so that means this is a resistance zone. When price came back to that third time, because first, second, third time, I knew for a fact that price is going to dump, or that is exactly what you need to see. So when price does this, you want to go to the lower time frame. There we go. This is the lower time frame of this. So this was a 4-hour time frame, I think. Then I scrolled back to the 15-minute time frame, and this is how price does. So this is how you trade this. You want to see price come back the third time or fourth time to the rejection block, and then you want to see a displacement. Okay, so price has been going up before we saw price break out below the lows with a displacement candle, right? And then during the process of breaking, what happened? We created a gap between candle number one, candle number two, candle number three. The middle part, that's a fair value gap. I wrote this a PPK, that's a breakaway fair value gap, I think. Yeah, that's why you see price never traded into that. So I'm going to explain later on. Breakaway fair value gap is another topic. Okay, it's basically a fair value gap. It's you don't want to see a fair value gap trade back into this. Whenever you see a momentum like this, sometimes the price leaves out a fair value gap that is not filled. So you want to call that a breakaway fair value gap. Okay, I'll get into that later on. But yeah, you saw a shift right here. Price traded back, not back, but continuously broke to the downside before we saw price retrace back. And why here we had a fair value gap, right? You can see that there was a fair value gap here, upper gap right here. This is the upper gap because of the volume imbalance that was created here. And then this is the third candle, candle number one, candle number two, stronger, candle number three. We created a gap. Price expected the gap, and then we take the sales towards our sell side liquidity, which is our targets. Okay, it's as simple as that, guys. I hope I really wish I had more examples of this, but yeah, I think I'm going to like make another video on this, maybe trading it live, because these literally plus my strategy, the strategy that I use. And yeah, so I don't know, maybe let me hear from you guys what next I should do. Although I've not made a I'm going to take you guys through literally all the PD arrays that I know of or that are there. Can tell that I have an order block pending here, so I'm going to make another video on what order blocks are and how to trade them. But yeah, I just decided let me just make these three of them first: breaker block, fair value gap, and rejection blocks. And I hope by now you already know how to trade them, how to identify them, and how to trade them, right? So yeah, that's all about it. And let me hear from you guys on what next I should do. Okay, and yeah, I'm gonna end it from there. Peace out, gang. Peace out, guys.